Hello and welcome to the Banker's Tech Talk video series, looking at all things fintech. It's been going now for about 6 years, and you can watch all the previous episodes on thebanker.com/techtalks. I'm Joy Macknight, editor of The Banker, and I'm joined by Amer Khan, who's European Managing Director at Entelligent, which is a climate risk analytics platform. Amer, thanks so much for joining me.
Nice to be with you, Joy.
So there seems to be a lot of focus on divestment when it comes to managing portfolios against climate change risk. What other options are available out there for asset managers?
The hot debate on divestment. Whether we like it or not, fossil fuels form a huge part of our global economy and won't be disappearing overnight, especially so in developing nations. In the UK, the transport and energy sectors are two of the largest contributors to greenhouse gas emissions. So asset managers must absolutely not just look away and ignore these fossil fuel intensive industries. Instead, we think they should adopt a two-pronged approach. Firstly, engagement. Asset managers can use their voice as an influential shareholder to ask management to better align their businesses with global targets for helping fix the climate crisis. For example, they might encourage their investee companies to invest more of their profits in green energy systems rather than pay them out as dividends. Or they may use their power to vote against non-climate aligned resolutions, such as an intention to build a new coal mine. Secondly, I think asset managers can use soft divestment rather than hard divestment. Technology such as the smart climate platform that we've developed here at Entelligent is used by asset managers and other financial institutions to identify the leaders and laggards in each sector. And by that, I mean we help them assess which portfolio companies appear better prepared for climate change, as well as those which appear to be more heavily exposed to climate change risks. And once they understand that, asset managers can use their capital to make sure it's directed more towards climate-friendly businesses.
Excellent. And I know you recently partnered with Prometheus Capital, which is an institutional investment firm, to deliver climate risk analysis. What kind of benefits will that bring to the firm's clients?
We're seeing asset owners, from institutional investors right through to the retail investor, increasingly demanding that their investment products are climate change friendly. And I think they're demanding this for two key reasons. An increasingly better understood humanitarian driver, that the climate crisis will permanently change our world for the worse if we don't deal with it, and an increasing appreciation that climate change factors can affect the financial performance of our investments. In years gone by, we've seen ESG and impact-focused organisations like ourselves and Prometheus Capital perhaps regarded as a nice, do-good, charitably minded type organisation. That's dramatically changed in recent years. Investors have very quickly realised that climate and other ESG issues are genuine factors that directly impact the financial performance of their investments. So Prometheus will work with us to integrate a better understanding of the level of climate and carbon risk that their investment portfolios inherently hold. And then they'll aggregate that with their knowledge and skills in other important ESG factors such as social welfare, diversity, and so on, to create investment portfolios that can be expected to do well both financially and ethically.
Okay, and then how can technology be used to help banks specifically manage their climate risk exposure?
Technology has a huge and increasingly vital role to play in this respect, I think. Traditionally, banks have had to look at the companies that they invest in to provide the carbon emission levels and other such sustainability data. And that data has typically been inconsistent, self-reported by those companies, and backwards looking. So by the time that banks get it, it's several months out of date often. Technology, or climate tech, as we like to call it, is now being used to allow banks to assess their investee companies in an independent and forward-looking manner. For example, climate scenario-based solutions such as the ones we provide. Here, we seek to manage climate risk by starting to understand the real driver, the climate system. That's probably the most complicated system known to humankind. So our systems take data that's been output by hugely complex climate models run on supercomputers for days on end, and then we apply machine learning and quantitative analysis techniques to identify patterns and signals between climate science and the financial capital markets. We then use those patterns to forecast and identify the level of climate risk in publicly listed securities and investment portfolios that banks are invested in.
Excellent. And a lot of banks are now talking about that move to net zero carbon emissions. So how is the whole sector really approaching this, and what could they do better maybe?
We're seeing very encouraging signs in this respect in the form of bold public statements on net zero promises. There are influential initiatives like Climate Action 100 that was set up by a number of organizations, including the Institutional Investors Group on Climate Change and the UN's Principles for Responsible Investment. Together, that now represents over 550 investors who between them control over $50 trillion of capital. And at a recent report, nearly half of the 167 companies that group of investors is engaged with had promised to reach net zero by 2050 or earlier. That's pretty impressive. Now, with the arrival of climate-friendly Biden and his administration in the US, the run-up to COP26 later this year, I think it's entirely reasonable to expect those types of commitments to only increase even more rapidly this year. And climate tech will play a very large role in helping financial institutions achieve their own promises in the portfolios that they hold in this respect.
Okay, well, you mentioned it there, but obviously the COP26, which is the big international climate meeting, is happening in the UK later this year. What do you think will be the main topics there?
Good question. Who knows what politicians and bureaucrats are going to focus on? But seriously, the first thing to remember is we're not currently on track to beat the climate crisis. We are on a failure path. So with that worrying thought in mind, I'd say the three biggest areas that are most likely to be focused on at COP26 are, firstly, assessing the actual performance of each nation against the promises that they made at the 2015 Paris Agreement, then agreeing what needs to be done by each nation over, say, the next 5 years to get us back on track and using the latest climate science that we have. And I think of specific relevance to the financial sector, what role carbon markets and carbon pricing might play in that journey. Today, we're seeing financial institutions involved in a very wide range of carbon trading markets, regulated ones and unregulated ones. They range from the original, often questioned clean development mechanism that was launched after the Kyoto Protocol all the way back in 1997, to the increasingly active EU emissions trading scheme and the Californian carbon markets today, as well as a number of various unregulated and voluntary carbon markets. I think there'll be a lot of focus on that, and financial institutions in particular will have a very keen eye on those discussions.
Excellent. Well, thanks so much for your insights, Amer.
Thank you.